Good afternoon. This is Ken Long from Tortoise Capital Management. I want to just spend a little bit of time walking you through some psychological insights with respect to short term trading and psychological mind states. Um, this is a pattern that's been working for me pretty well on an intraday, also longer time frames, but mostly intraday. Things that I'm looking for are basically periods where I have favored stocks or ETFs, things that I'm comfortable trading, and I've seen an extraordinarily big sell or a condition of max pain, something where the market has voted violently against it. Then there comes a period of time when it looks like it hasn't been failing anymore, but it's too soon to call it support. And then if it holds that support level above that red dotted line, there forms what I've been calling the shelf, or a period of reduced volatility compared to that big sell, and finding a support level, but it hasn't broken out. It's just a period of time in which it has failed to fail any further, but prior to any potential breakout. And so on an intraday basis, after like about 20 to 30 minutes, so anywhere from 4 to 6 individual 5-minute candles where it hasn't failed and it's gotten compressed volatility. At some point I call that the shelf, and now I'm ready to start playing a rebound. Now I'll do that if we're in a bull market and I see SPY, the market itself, showing signs of tactical momentum, because what I want to do is make sure that I'm going at least in the same direction as the market. Ideally, the market's already made a hook, and then this is going to play catch up. That's the best condition of all, because then you can see the market turning, and this laggard has some catching up to do. So if it has made a big sell and then formed a shelf, and the market is improving, then I'm starting to think of trying to buy a breakout with tactical momentum when it breaks out of that shelf, either at the solid green line, and sometimes, depending on what the actual candle formation looks like, I may be able to go a little bit earlier at this dotted line, or I might have to wait a little longer for more confirmation at that green line, dotted green line. And then on the downside, my initial stop I'm normally looking for just below the shelf, and again, based on evidence and price formations, I may be able to get that a little bit closer. I might have to play a little bit wider, but all of this goes into deciding how I'm going to frame that initial risk, or the initial R, risk per share. And then I'm looking back up here into the big sell to find on these purple lines some likely resistance levels. And it might be a retest of the swing high, or where it first started to fail, or some intermediate place where if there was a doji, I might draw this line. And what I'm looking for is the ability to see 2 units of reward per 1 unit of risk. So that's sort of my mindset. Or the pattern that I'm trying to look for. A period of great pain, then leveling off, finding some quiet, and then a morning hook. You'll hear us describe it in the trading room sometimes. The mindset that I have is very much like a mongoose stalking a cobra. I'm very willing to get out of this trade once I put it on. I have no belief that this thing is actually going to work. I don't have any reputation involved here. I'm simply buying an opportunity, and I'm more than willing to scratch this or take a fractional loss if I just don't see the follow-through happening. So if the market takes off and this thing's not working, that might be enough to get me out of it. Failure to follow through is evidence, and I maybe don't have to wait for failure. And this way I end up taking fractional R losses instead of full R losses. The main point on this general strategy is that you never want to be taking more than a 1R loss. If you've done that, you are either putting your stop too close and you can't manage it, or you have a belief that this thing should work and that you must be right, and therefore you're hesitating to get out of the position. So you should never be taking more than 1R loss on this. In fact, fractional R losses are an indication that you get it. A good story to read to help you develop this mindset is Rikki Tikki Tavi by Kipling. It's the story of the mongoose that goes after the cobras. Now, something else I want to talk about here are the different energy levels, or the mind states that I see myself going through in this general pattern. The dotted blue line is just my symbol on the chart that says I'm always interested in this particular symbol because it's an old reliable, or a cow, as we've called it at times. A big, fat, slow, reliable, steady, manageable large cap, or a liquid ETF that represents a broad index, something that's not as subject to market maker manipulation as perhaps an individual stock. So I'm always interested in members of the Dow 30, the S&P 100, the broad regional ETFs, so the world market model, or a very liquid ETF. And so that's what that blue dotted line means. They're always on my radar screen. I'm not ready to trade them immediately, but I'm always aware of where they are in their annual, their 30-day, and their 10-day trading ranges, so I can find moments of opportunity at either end of the extremes of those time periods. Now, after a big sell, and even as that big sell is occurring, there comes a moment when I'm really interested in this, and I see this little shelf perhaps starting to form, and that's where my interest, my general interest, becomes one of alert. I get alert at the sight and sound of a pain event, and so I've now defined this as a big sell. My energy level goes up one state, and now I am alerted for the possibility. When I see it failing to fail further, and I see confirmation of the shelf starting to form, I can see that the target is laying quietly, and now I can start thinking about framing this. And I use that dotted red line, or this emerging red line here, as my lower limit, and I can already start looking for places up in the big sell where I can get, I can see profit targets at resistance levels, and I'm already starting to think about where's the 2-to-1 line, and then I can look at the top form of that shelf that seems to be emerging and see by inspection if I have 2-to-1. So when I see the shelf being confirmed, I am now actively framing the trade. Now at this solid blue line, I've confirmed that the shelf is there. I am ready to strike as soon as I see price hit my entry levels with my risk carefully defined. I'm ready to strike. Now, I'm always ready to bail because I don't believe in this at all, just like the mongoose. I may look like a drunkard at some times, but I got to make sure that I don't fail on this one because the bite of the cobra is deadly. Failure of this trade, sticking around too long, will get you killed. And so I'm ready to bail at any moment. However, I'm also keen on the opportunity that is presented. So at the solid blue line, I have framed the trade with my entry defined, my risk defined, my profit targets established, my 2-to-1 clearly established on the upside. And what I have observed in this process is that I have come to know the physiological signs in myself as I progress through each of these stages. That when I see certain charts on my scans, or if I see a threshold being hit on my spreadsheet and a little light flashes on there because I've done some conditional formatting, I observe the physiological signs of mental state change that occurs. And I know what those are, and I'm aware of the influence and impact they have on me and my decision making, so I am keen to monitor my own physiological state. I always know where I am in the stock, and if it breaks out and goes before I'm ready, then that's just one that got away. Another one's going to come around. I will not trade until I've got my game face on and I've actually framed that trade and I can see what's happening. And then I always remember that I have an out. I always know where my exit point is, and my finger is always on the trigger, ready to go, because the main psychological edge that I have in this is that I have no need to be right. I don't need to be right. I just need to make money by the end of the day. And so if I get 4 false starts and they're fractional R losses, and I only get the last one that works and it's a 2 to 3 or 4 R winner, and I net out positive today for the day, then I'm good to go. So fractional R losses, multiple R wins, plenty of opportunities, monitoring your psychological state, know the signs, know how to manage them, manage and monitor your risk, and then trade in symbols that you have familiarity with. You know how they behave. Make those your old reliables. Those become an edge for you in the daily intraday trading frame, in the game of intraday trading. So thanks for your attention, and have a great day.